Welcome back to the Macro Market Report, where we break down the world's most important financial trends so you can stay one step ahead of the markets. This week, we've got a full spectrum of insights, from a dire warning on U.S. fiscal policy, to bullish calls on gold and silver, to renewed institutional interest in Bitcoin. We'll also take a hard look at equity markets at a tipping point, why REITs might be quietly undervalued, and how the energy sector is being reshaped by the AI boom. So let's dive in. Lynn Alden delivered a powerful address at the 2025 Bitcoin conference, framing the U.S. fiscal outlook as fundamentally unsustainable. She emphasizes that since 2017, U.S. deficits have decoupled from unemployment levels, signaling a structural shift. Unlike previous decades, raising interest rates no longer slows economic activity effectively, but instead worsens the deficit due to the massive size of the federal debt. The current system is dependent on constant economic growth to avoid collapse. Her solution? Accumulate high-quality, scarce assets like Bitcoin. Luke Groman on the Daniela Cambone Show says the U.S. cannot sustain a trade war with China without imposing capital controls that limit the flow of money in and out of the country. If the U.S. keeps its capital account open while China restricts capital flows, then U.S. investors remain at risk for asset sell-offs, extreme market volatility, and rising bond yields that could cause a fiscal crisis. Groman reinforces the narrative that gold has been legitimized post-2008 as a reserve alternative, given that central banks around the world stopped accumulating U.S. treasuries and pivoted toward gold. Jeff Snyder highlights rising unemployment in Germany and France, which he believes will push the ECB toward further rate cuts. Central banks in Australia, New Zealand, South Korea, and other countries have already eased. The overarching trend? Global central banks are capitulating to economic reality. Real wages are declining, households have not recovered their purchasing power since the pandemic, and economic growth is stagnant. The consensus across analysts remains bullish on gold and silver in the long term, with nuanced short-term caution. Chris Vermeulen predicts a short-term target of $3,750 for gold, while Gareth Soloway sees long-term strength if the metal holds above $3,150. However, he notes short-term selling pressure. Patrick Seresna highlights a 6-week consolidation above the 50-day moving average and targets an upside move toward $3,600 to $3,700. Jordan Roy Byrne expects a summer of sideways action for gold and silver, but sees the foundation being laid for a breakout. He's particularly optimistic about junior miners, which are currently outperforming the metals themselves. Mike Maloney emphasizes that monetary demand for silver, not industrial usage, is the key driver. He called silver undervalued and questioned why tech giants like Apple and Tesla aren't stockpiling it, given their dependency on the metal. Ronald Stofferle, on Palisades Gold Radio, believes gold is in the public participation phase of its bull market, a time when investor enthusiasm and price momentum spike. He targets $4,800 gold by decade's end and expects silver to follow with a slingshot move once key resistance breaks. He also foresees increased M&A in mining stocks and emphasized the need to time mining stock exposure carefully due to their volatility. Rick Rule, on the Maggie Lake Talking Markets podcast, also reinforces a bullish, long-term gold narrative, seeing ongoing U.S. dollar devaluation as inevitable and citing the 1970s as a historical parallel. He sees this environment as favorable for both gold and resource companies. On the Macro Dirt podcast, Tony Greer says he's long gold miners, but warns gold is at a pivot point. If support levels fail, a breakdown could occur. Platinum was also mentioned as gaining momentum, with Jared Dillian observing a breakout and becoming bullish on the trade. Lynn Alden strongly recommends Bitcoin as a lifeboat asset amid growing fiscal and monetary instability. She warns that traditional assets would fail to preserve purchasing power in a system spiraling into debt. On Michael Campbell's Money Talks podcast, Joey Temperley highlights growing institutional adoption of Bitcoin. He notes that pension funds and endowments are starting to allocate to crypto not for speculative purposes, but as long-term strategic positions. Gareth Soloway says Bitcoin has near-term support at $104,500 with a downside risk to $97,000 should markets turn south. On the upside, a bullish environment could see Bitcoin reaching $114,000. The equity market is at a decision point, with opinions divided between near-term bullishness and longer-term caution. Chris Vermeulen says the recent market action is uncertain, noting that institutions are selling into rallies, a bearish signal. He believes we may be in a stage 4 decline phase, signaling a major downturn. Gareth Soloway sees 5,965 on the S&P as a crucial resistance level. A breakout could lead to a retest of 6,200. However, the upcoming U.S. jobs data could be the trigger for either a continuation or sharp reversal. Patrick Ceresna and Eric Townsend observed a post-NVIDIA rally that quickly fizzled, indicating investors may be selling into strength, a potential red flag for market momentum. Ceresna believes a short-term double top could form if data surprises on the upside. Larry Berman expects the S&P to pull back to 5,400 to 5,500 in June, with direction thereafter dependent on tariff headlines. Tony Greer is short-term bullish and currently long, while Jared Dillian is standing aside, expecting a rollover in equities by fall. Keith Richards observes a short-term divergence between TLT, long-term treasuries, and the S&P, suggesting we're entering a phase where either stocks drop significantly or bonds rise. He warns that if Treasury yields exceed S&P earnings yields, equities could lose their appeal. Dennis Mitchell on the In the Money podcast sees a potential opportunity in Canadian REITs, which he says are trading at a 20% discount and offer 4% plus tax-efficient dividends. Despite market negativity due to rising rates, he believes investors are missing out on long-term compounded returns. The key to upside lies in bond yields coming down, which would reduce cap rates and raise REIT valuations. Oil remains stuck in consolidation, with major resistance at $65 and support at $55, according to Soloway and others. Ceresna says a short squeeze could lift oil prices 10% quickly if sentiment shifts. Natural gas is consolidating between $3 and $4, but Keith Richards remains bullish, citing long-term fundamentals and its lack of correlation to equities. He prefers natural gas stocks and sees them as undervalued assets in an increasingly unstable macro environment. Doomberg, on the Outlier Trading podcast, emphasizes the growing energy demands of AI infrastructure and warned that unless SMRs, small modular reactors, or other nuclear solutions are deployed, energy prices could spike so dramatically that even internet functionality could become strained. He emphasizes the need to make energy cheap and abundant to keep up with AI's exponential growth. He sees natural gas and nuclear as the only realistic solutions. Rick Rule is similarly bullish on uranium, noting it powers 14% of U.S. baseload electricity. He views price pullbacks in uranium as buying opportunities, advocating for a long-term outlook. Patrick Ceresna echoes this, preferring physical uranium over mining stocks and awaiting a pullback to re-enter. The bond market is flashing signals that should not be ignored. Keith Richards expects the U.S. 10-year yield to hit 5%, and if this surpasses equity earnings yields, it could trigger a capital rotation from stocks to bonds. The U.S. dollar, while weak recently, Vermeulen says it may move higher in the short term. Ceresna believes the dollar will remain range-bound between 99 and 103, but Dillian is still bullish and waiting for a bounce. Jeff Snyder emphasizes that rate cuts are coming globally. Countries are already adjusting to the post-pandemic economic hangover, with central banks loosening policy in the face of poor growth and weak wage recovery. Well, it looks like we may be living through a turning point in financial history, and many experienced investors are positioning into hard assets and asymmetric opportunities. Gold and silver remain long-term bullish plays, while Bitcoin continues to gain ground as a hedge against fiat deterioration. Plus, real estate and other commodities may be offering pockets of value, especially in natural gas and uranium, amid the world's mounting energy demands. What do you think? Please leave a comment about where you're positioning yourself now and join in on the discussion. If you found this breakdown helpful, be sure to like, subscribe, and hit the bell so you don't miss next week's update. Until then, stay informed and stay nimble. Thanks for watching.